Every single month, my projected annual dividend income continues to climb higher and higher. And this is in large part due to the fact that I focus on buying quality stocks that continue to increase their dividend payouts every single year. So in this video, we're going to be looking at 3 different stocks that recently announced dividend increases, 2 which are pretty nice dividend hikes, and then 1 that is a little bit disappointing. So let's jump into it. Now, our first dividend hike was a massive one, and this is one that I own in my personal portfolio, and that is from Domino's Pizza. They announced a 15.2% dividend increase, and Domino's has a phenomenal history of growing that dividend, as we'll see here in just a moment. Now, over the past year, the share price has been a little bit choppy. It's down about 3.51%, but at one point it was trading as high as around $540 per share. Now, if we look at the past decade, they actually have market-beating returns. But if we look at them from a dividend perspective, go ahead and jump over here and plug in DPZ. All the data will load in. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, the starting dividend yield for Domino's Pizza, sitting at about 1.31%, but the 10-year dividend growth rate is above 17%, and over the past 5 years, 14%. So even this most recent dividend hike was even larger than the past 5 years, and we can see this is all backed by a high level of growing free cash flow. So what's beautiful about this is even though they're growing their dividend at a very high rate, for the past decade, their free cash flow payout ratio has remained in the range of around 40% to as low as 25%. So they still have plenty of capital left over to do things like either buy back shares or reinvest back into the business, which definitely leads me to believe that this dividend growth moving forward will be sustainable. Now, if we take a closer look at Domino's, let's look at them from a yield on cost perspective. What would our yield on cost look like if we would have bought them around 10 years ago? And what we can see is our yield on cost would be above 7%. So even though that starting dividend yield is quite low, your yield on cost in just a 10-year time period is above 7%. Combine that with massive share price appreciation. So just imagine what's possible if you buy these stocks with a 10, 20, or even 30-year time horizon. Coming in at number 2, we have an energy stock, and that is Diamondback Energy with a massive 11.1% dividend increase. That's a really large dividend increase for an energy stock. And to be more specific, this is an oil stock. Now, what we can see is the last year for the company has been relatively rough. They're down around 22.56%. But if we look at the past 5 years, they've actually done very, very well, outperforming the market up around 188.8%. Now, if we go ahead and look at them from a dividend perspective, I've already plugged in the stock ticker. We can see that starting dividend yield is sitting at about 4.42%. But if we look at the dividend payouts here, what's going on? It looks like there's a lot of fluctuation. Well, one of the things we have to understand about Diamondback Energy is how they allocate capital. Obviously, the amount of free cash flow that these energy companies produce can vary quite a bit year to year, meaning at times they can choose to pay out special dividends when they generate lots of free cash flow. And this is exactly what they talk about in their investors presentation. So for example, we can see they had a total return of capital of $694 million, which represent around 51% of Q4 2024 adjusted free cash flow distributed through the base dividend and share repurchases. So if we come up here and look at their return of capital framework, what we can see is the primary objective is to deliver a base dividend, which is around $1 per share. Then they want to do share repurchases, and then any extra free cash flow that's left over, they want to distribute as variable dividends. So when we take a closer look at that dividend history for this company, what we come to understand is these larger dividends are actually special dividend payments. They're paying out these special dividends because they generated more free cash flow than they really know what to do with. So like most energy companies, this is a stock very focused on rewarding their shareholders with things like share buybacks and paying out dividends. Now keep in mind, anytime we talk about energy or oil stocks, these companies can be quite cyclical, and I usually point this out by showing the free cash flow chart. Here's what I want to point out. If we come over and look at the free cash flow analysis, look at how much the free cash flow margin has changed over the past decade. Remember, free cash flow margin is telling us for every $100 in revenue that the company generates, how much is actually becoming free cash flow. And again, we can see there's a lot of variance, even in just the last few years, but especially if we look at it over a decade time period. And then lastly, we have a lackluster dividend increase from the Home Depot company coming in at 2.2%. And again, I always have to remind you, anytime we have a dividend hike that is lower than the rate of inflation, the company technically hasn't even increased their dividend payouts. So that is something to keep an eye out. Pretty disappointing dividend increase. So let's see what's going on with the company. Now, to start off, we have to acknowledge the past decade has been quite good. They're up about 221%. But if we look at the past year, the stock is relatively flat, down about 1.99%, and they've especially seen a sell-off in the past month, currently down around 11%. Now, if we jump over to our dividend breakdown sheet and look at Home Depot, what we can see is the company has a starting dividend yield sitting around 2.41%, and a very nice history of growing that dividend over time. The 10-year dividend CAGR is actually quite high, sitting at about 14.5%, and the 5-year close to 9%. So this recent dividend hike of 2.2% probably caught quite a few investors by surprise. Now, one of the things we can see is the free cash flow payout ratio is sitting at about 54.7%. So in 2024, the company only used 54% of their free cash flow to actually pay out dividends. And that's a relatively healthy range, but what we can see is over the past decade, it's climbed up just a little bit. Now, it's still in a healthy range, but this recent dividend increase could tell us the company's concerned about their future free cash flow growth. We have to remember, typically speaking, growing dividends is a sign that management is confident in the health and the future earnings potential of the company. And if we jump over to the stock screener, come up here and plug in Home Depot. Again, the data will load in thanks to ticker data, but what we can see is earnings really haven't grown over the last few years. In fact, 2024 is even lower than it was in 2021. So earnings growth has actually stagnated, not a great sign for the company. So what do the projections look like moving forward? Well, if we jump back over to Home Depot on Seeking Alpha and look at the earnings estimates from analysts, we can see again in 2026, it looks like earnings really aren't projected to grow at a very high rate, maybe only around 1%. But after that, we're actually talking about pretty solid earnings growth projected to be between around 8 to 10%. But for now, it looks like perhaps the company is wanting to keep their free cash flow payout ratio in a healthy range while earnings remain relatively stagnant. So there you go. Those are 3 dividend stocks that recently announced dividend increases. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.